A couple business items. One, we are no longer using Calendly. So many of you have and use Calendly links to schedule appointments. We're now using meetings. You will receive information on that if you haven't already on how to schedule those appointments on demand. Um, in the meantime, you can always reach out to Lynn and schedule a time. Um, Secondly, I want to thank many of you. So far in the first week of the year, we've received a huge amount of referrals. So I appreciate that and want to thank you for thinking of us and trusting us to help your loved ones. So thank you for that. Um, with that, I think we'll just jump in. So normal topics: the market, treasuries, the economy, the Fed, alts, and takeaways. So S&P 500, I pulled up a 1 month chart in particular because I wanted to show where I think things are going. And we've talked about sometime between uh, the beginning of December and inauguration that I thought we'd peak in the stock market and start our long slog downhill. So you'll see about mid-December, we had a peak up around 6,100. And then since then, we've set two lower highs. And I think through the rest of the year, we're going to see a continuation of that, where we're setting lower highs, where you're seeing that trend line get lower and lower and lower. And each of those lower highs is often where the smart money is driving the market up to get out. And so I think we're going to see that through the rest of this year. So, interesting stat here: the market cap of the largest stock relative to 75th percentile stock weight of the top 10 stocks in the S&P. So basically what this is showing is that the top 10 stocks are a huge percentage of the overall value of the stock market right now, to the point that they're at the same place we were back in the Great Depression, actually a little bit higher. And we're likely to see those stocks come back significantly to the field, or reversion to the mean, over the next several months. And we'll look at a few of those later on. So here's another interesting one: forward PE ratios and subsequent 10-year returns. So when the forward PEs on the bottom axis get above 20, you see their returns start to go down. Their forward returns go down. The green line represents where we are now. And so it looks very much like we're going to have negative returns on those positions going forward. That shouldn't be a surprise to you. That's what we expect, but this is just confirming that information. Okay, this one's a little hard to see, but the top line is representing the yield curve. So when it's in the red in the top portion, that's when it's an inverse yield curve. And you'll see we just went back into the green. So historically, when a treasury market or interest rate market reverts back to the normal, where long-term bonds pay a higher interest than short-term bonds, what you see is a drop in the market. And so you'll see the previous times that happened, And below that is the S&P 500 returns. So you'll see it goes green up at the top, and then you'll see a drop in the market. So on that bottom line, what it's showing is the expected returns of the S&P now that we've gone back into the green on the yield curve. So basically, the takeaway from this is the yield curve has gone back to where it theoretically should be, long-term bonds paying higher interest than short-term bonds. And that in turn should drive the market down. Just more confirmation of what we've been talking about. 20-year treasuries. So we're seeing yields on the treasuries very high right now, up around 5%, which is a historical norm for the long-term treasuries. When you see long-term bonds paying higher interest than short-term bonds, people start buying long-term bonds because they're worried that interest rates are going to go down, which they are. And so they start buying up these bonds to get those higher yields, and that ultimately drives the yields down. I would guess next month or two, you'll see that peak and start to come down, and you'll see those long-term treasury bonds go up in value. Similarly, but to a lesser extent, you should see the same thing with the tips. Again, they're up near their annual high for yield. Again, the other component for the tips is inflation. So we are seeing a step up in inflation, and I think we'll see that in some areas through this year. And in some areas, fuel costs, those sorts of things, I think we'll see deflation. So, and eventually that deflation will pass on to everything else. So we finally had a move on the Fedometer. It looks like we're moving slightly more aggressive Fed policy. Last year, we had 3 successive rate cuts. I wouldn't be surprised if they don't cut in their first meeting this year, with a new president coming in and kind of feeling out where things are going. But I do suspect they will be forced to continue to cut through potentially the remainder of this year. So that's good for bonds. That's good for the economy. And ultimately, I do think we'll see effective 0% rates as we did a few years ago, as the economy kind of cleans up. So gold, we saw it spike up, and it's pulled back a little bit from where it was. We're still pretty high. I think this year you're going to see gold continue on that trend upward, especially as the stock market starts to come down. You'll see a flight to those long-term bonds that are paying 5%, to the gold, and next to the silver. So we're getting to a good opportunity to take advantage of those. We pulled back on the long-term treasuries. We had them spike up. We pulled some of our gains off the table. We did the same with gold and silver, and now it's an opportunity to get back in. We thought there might be a quick short-term opportunity, and it's actually played out to be more of a long-term opportunity. It's come down slowly. So there are some opportunities there.